So let's talk about this. US exporters and officials also frequently claim that the Chinese government maintained the value of yuan at its artificially low. They suggest that the Chinese government should revalue the yuan upward to correct the large balance of trade deficit with China. This issue received much attention in 2008 and 2011 period, and also in 2020 to 21 when they have a trade war. So government officials were searching for the solution to stimulate the US economy. Some government officials believe that if the Chinese yuan is revalued upward, US exports will increase and US imports would decrease with China. So US and China. So US is exporting less and China is importing to US is importing from China more than 400 billion plus from exports. So that's why they have a trade deficit of $400 billion. So this causes their economy to weaken. So in order to boost their economy, their experts suggest that if yuan is upward, so our importers will they won't buy Chinese goods because Chinese goods become more expensive. So they won't buy. So in that case, these $400 billion will be decreased. What is the Chinese response? Chinese say that, so China say that it is because of the influence is because of the cost of labor. Furthermore, if the Chinese government revalued its yuan upward, what will happen? Did the US importers will stop buying? They will buy from another country. So in that case, US deficit will shift it from us to some other country like Vietnam, Mexico, Bangladesh, Vietnam, Malaysia. So in that case, that problem still exists. It doesn't mean that if I revalue my yuan upward, so it means you will not buy from me, you will buy from some other country. So some other country you are also creating the deficit, right? In that case, the thing gonna be is that our deficit, this $400 billion deficit will be distributed to other countries. The problem still exists, right? So it doesn't make any sense. So that's why this dispute doesn't resolve at the still it's still persist. So does that mean the US government officials will argue that these low wages countries need to revalue their currencies to reduce the value of the trade deficit up? So if other countries have a low labor cost, so it means if they are having a great deficit with you, and then they also have to revalue their currencies upward. So in that case, you will be benefited, but other countries will be, will be at disadvantage. Nobody will buy from them, right? So this dispute still exists. Now, factors affecting the direct foreign investment. We talked about that. Foreign investments can be done through a number of ways, through a number of cases. Number one, if you go there and buy land and construct your own building and start producing. Second, if you acquire in foreign countries a business, if you purchase a business. Third, if you invest in the stock exchange of other country. We call this direct foreign investment through acquiring, purchasing, constructing or establishing a company, or direct foreign investment through portfolio, which means investing in security and exchange. So it definitely affects the flow of funds. Changing in restrictions means new opportunities have arisen from removal of government barriers, like America changes the restriction. Now Chinese can invest in New York Stock Exchange, Pakistani, Bangladesh, Russians, Vietnam, Koreans, they can invest in New York Stock Exchange. So they receive more foreign flow of capital. Not from foreign, they receive more flow of capital. Privatization, if one country sells its own assets like electricity generation company or rail company, right, or water supply company, so they receive more funds because more companies will come there and do the business, right? Now international flow of funds in fourth part is how this affect the direct foreign investment, potential economic growth. If one country's economic growth is positive, its outlook is positive, more countries or companies will invest in there when the economic growth is there, so they can be benefited from the extra amount of money that they will receive. Tax rates. In a country where tax rates are lower, other companies or countries will invest over there to receive more money over there or more profits over there. Exchange rates. Firms typically prefer to pursue direct foreign investment in those countries whose currency is expected to strengthen. Right now, their currency is lower, but after 6 months, 3 months, or whatsoever, their currency is expected to increase. So what happened? They purchase over there at a lower price, and what happened after exchange rate increases? They sell it and receive more dollars, right? So in this case, this is also one strategy. Mostly it is used in forex market when you buy currency, because you expect that, okay, this currency is going to be rising in 2 days, so you buy that currency, you hold it, and after 2 days you sell it, right? So under these conditions, they can invest funds to establish their operations in a country while the country's currency is relatively cheap. Right now, exchange rate is not that high. Then earnings from the new operations can periodically be converted back to the country's currency at a more favorable exchange rate. So in that case, you will receive more inflows of funds. Now, portfolio investments. When you want to invest in stock exchange. So tax rate on dividends or interest. If a country reduces the tax on dividends and interest rate, so many other countries and companies want to invest there to exploit this benefit of tax rate. Interest rate, if a country is giving more interest rate, what happened? Money tends to flow there, high interest rate countries, right? And remember that its currency is not expected to weak. If weak, then when they convert back to their home currency, they will receive less, right? So remember that their currency either stable or increasing, and with high interest rate, they will invest over there. Third one is exchange rate. Investors are attracted to a currency that is expected to strengthen. So right now it's cheap, buy it. When the value increases, they sell it. Same, the profit principle is buy, low, sell high. So whether it is currency, whether it is stocks, bonds, right? So where currency is expected to increase, it means right now it is cheaper. Buy now. Currency or maybe the shares, after that sell it to just benefit from exchange rates. That's it. Impact of international cash flows. So United States relies heavily on foreign investments, right? Because the US manufacturing plants, offices, and other buildings, debt securities issued by the US firms, US Treasury debt securities. So foreign investments are needed by the US. Why? Because they need to buy, they need to manufacture plants. Over there are high-tech companies who make big plants, right? Tesla plants they are making and they're exporting to other countries, right? To operationalize, or big plants and machinery they are, and also they are establishing offices and buildings over there. So many it is wish of every company to list itself in New York Stock Exchange. Of course, there is going to be office over there and buildings over there as well. So they receive more money. Plus, in order to finance their debt, if they go to their local banks, maybe they are charging more interest rate. So why not they go to the other foreign countries over there, they can find out the less interest, or they ask other countries to buy our debt securities, give us loans, right? So that we can finance our country's operations, and we will give you back the return interest later on. So everybody wants to invest in US because US is a superpower as well. Plus it has a huge market, trusted market, New York Stock Exchange. Foreign investors are especially attracted to US financial markets when the interest rate in their home country is substantially lower than the United States. So normally the interest rate in United States is always high. It doesn't mean that 5% and my country it's in 15%. Doesn't mean that. It's dollar interest rate, right? So over 100,000 investment, you will receive 5%. 5% is 5,000. So when you convert back into home currency, the amount going to be huge, right? So that's why many people, they want to invest in US. So what happened when, so this is the basically impact of international flow of funds on US interest rates and business investment in United States. So if you see that these are the long-term interest rates and this is the amount of funds. So what happened here? So this basically demand and supply. So supply, because everybody wants to invest in US, right, in dollars. So when supply of dollar increases, we have a new interest rate. So long-term interest rate decreases. When long-term interest rate decreases, right? Example from 5 to 4%. What happened? It is cheaper in US companies to acquire funds on cheaper rates. Previously it was 5%, now it is 4%. So they will expand more. The amount of business investments. So they will be asking more loan for business expansion, business, mergers, acquisitions, like that. So this is the benefit of investing in US. So we have one more question. Oh, sorry guys. We'll start from here in our next class. So time's up. I'm sorry I took more 10 minutes of more of your class. Sorry about that. So in the next class we will be finishing this chapter, and we will be having assignment as well. So if you have any question, you can ask. You can also drop me WeChat message, and we will be starting from here. I will be starting in our next class from this impact of international flow of funds on US. I would be explaining, if you don't understand this diagram, I would be explaining one more time. Okay. Take care.
Okay. Thank you, sir.
Take care.
Goodbye.
Okay, thank you, sir. Have a nice day.
So